Welcome back, everyone. This week we're going to be talking about market sentiment and what we can do about it, knowing what we know. Remember, information is meant to put us in formation. We need to be asking ourselves what actionable, practical, pragmatic things can we do from the data set that we have? And or is the data set large enough to know what to do? Because just because you have information doesn't mean you have sufficient information to take any action. And just because the market's greedy doesn't mean that a reversion to the mean or a drawdown is necessarily imminent or immediate. Anyone who's familiar with the CNN Fear and Greed Index will recognize this picture. And currently we're sitting at 82, which isn't max optimism or max greed, but it's well enough up there that it's considered extreme greed. So what does that mean for the upcoming days, weeks, months, and quarters? Because that's what we care about. So we know how to position. Do we sell? Do we buy? Do we accumulate cash? Do we sell calls, puts? Like, what do we do? And the point of this is not to get emotionally riled up or manufacture indignation and point and sputter at people. The point is to make money. Now, something's very, very interesting is happening in this chart. And what this chart is the Fear and Greed Index on a weekly time scale on a bar chart. And then at the bottom, you'll see the Fear and Greed Index. The top's the S&P 500 index, and the bottom's the Fear and Greed Index. And what you notice, the way that most people talk about the Greed Index is that when it gets to extreme greed, that you should be cautious in the markets. But look at this chart. What does it tell you? When it hits 75, which denotes greed, that the markets go up. Well, if the markets statistically go up when the Fear and Greed Index is in the greed mode, why would you think about selling? It's a counterintuitive reality. But if you look at the S&P index, if you look at the green bar charts, what you'll see is that once it hits greed territory, more likely than not, the market is to continue higher. Not reverse, but to go higher. And perhaps an even more interesting thing is that sentiment is predictive to some extent. Because in the red charts, you'll see that's when the Greed and Fear Index is below 25. And so what does that mean? That means that the market's likely to either go lower or kind of distribute itself over several weeks, like at the beginning of 2016 or like in the middle of 2019. Or it could fall off a cliff like it did in the beginning of 2020 or at the end of 2018. Anybody around at that time will remember that's when the market panicked because Jerome Powell was raising interest rates and seemingly we couldn't get anywhere with it before the market puked. It puked in December. I recall that very well. And I also recall 2017 to the beginning of 2018, the market just ripped and it had very few drawdowns that entire year. And that's interesting. Just imagine you saw that green bar at the beginning of 2017 and said, oh, this market's going to reverse. Well, look what it did. It did anything but reverse. Here's the Greed and Fear Index overlaid with the S&P 500. And the problem with this kind of chart is that it doesn't tell you the percentage moves. It just looks like a very volatile chart, so it might prompt you to be concerned. And, oh, by the way, as always, in the description of the video, you'll find links to many of these charts. I recommend you go explore and educate yourself. with that said, what you see here is that when the CNN Fear and Greed Index gets roughly above 75, which is the y-axis on the left side, you'll see that the S&P also peaks out at about that time, and then the S&P retraces until the Fear and Greed Index dips down to, call it 15, roughly 15 or 30 to 15, and then it goes back up or tracks sideways. So one of the questions you have to ask yourself what to do with this information is, what kind of time frame are you trading on or investing in or speculating with? Because that's kind of relevant. So you could say you can still be optimistically cautious when the greed index gets above 75 and know that in recent history, the last, call it 5 to 10 years, that the market often went higher the following weeks. But you're cautiously optimistic. The funny thing is when the greed index gets below, 25 is actually when you should actually be fearful. It's so interesting. People want to be fearful when there's greed in the market. But look at this chart going back to 2016. When the market gets greedy, you shouldn't be fearful. Because statistically, with this sample set, the market is prone to go higher. And it's when the market gets fearful that you should get fearful, which is to say that when others are greedy, you should be greedy, and when others are fearful, you should be fearful. Now, we all know that juxtaposed to the Warren Buffett quote that people love to bastardize and misappropriate and co-opt, that you should be greedy when they're fearful and fearful when they're greedy. But look at this evidence. Now, that's the problem, is when you take things out of context and then apply it to situations that it's not applicable to, such as this chart and such as this indicator. I digress. Here's an interesting chart I came across. S&P days without a negative 1% decline. So far, well, not so far, as of 7/19, July 19th, 2023, we had gone 37 days with less than a 1% drawdown. And that reminded me, what actually prompted me to discover this chart was I remembered back in 2017 how the market just seemed to go up every day with just a tick higher every day, and then a tiny little drawdown. And sure enough, I looked at it, 2017, 109 days and 112 days. And I remember that very well. So you say 37 days. Okay, there's no context to that. Oh, the market's gone up 37 days in a row with less than a 1% drawdown. Okay, what does that mean? It's a hyperbolic headline number without a denominator. Like, what's the sample size? Okay, like is that normal? Is that an outlier? How much of an outlier? And what you'll find is that that's normal enough. You can see that the median that we are currently in what might be considered the median range of that. And that's a consequence of these. That's, well, I don't want to say median, the average. We're within the average. And the reason that it's the average is because of these crazy times and periods where you had 109 and 112, and then that offsets the lower numbers. So is it abnormal? Because you look at all these tiny little red bars at the bottom of the screen, and there's a bunch more of those than what we're currently in. So yes, it's not the typical thing, historically speaking. This chart goes back to 97, but it's not unheard of, and it's not necessarily crazy. So let's contextualize it. I think this chart does a better job of kind of visualizing it. It only goes back to 2019, and so yeah, I mean, perhaps a drawdown is around the corner, but then the question is, what kind of drawdown are we talking about? all you need is the sentiment to reset. And if people are really spooked by the markets, as I covered last week about people just now covering shorts that they put on at the beginning of the year, which could be used as a contra indicator as to saying, okay, the shorts have covered, we're at the top, no one's left to buy since everyone's covering, Carvana's up 1,100% this year, this must be the peak. Well, the peak of what time frame? The next month? The next 3 months? And what's the drawdown? Can we not just trade sideways and that would reset the sentiment? That would reset, the MACD and the RSI or whatever technical indicators you want to use? You have to think about these things. So I see this being passed around here of late. AAII sentiment survey, percent of bulls minus percentage of bears. And what you see is we're kind of at this upper range, 30%. Okay, what do you do with that? Like I've said, I see this chart and it's to prompt you, oh, that's scary. Look at that. Well, look at this chart. How about that? You see these brown sections as opposed to the red sections? Well, to me, this brown section is just beginning. And if you go back and look at these other brown sections as opposed to the red sections, you'll see that there's time periods of big red sections and time periods of brown sections versus red sections versus brown sections, and on it goes back to 2009. And what you see is that pretty much all of 2022 was a big red section. So we just started, which is funny because just started means I'm speaking of a 7-month time period. We just started getting back into the brown. So does that mean that the market's constructive and promising? I mean, you tell me. This chart's not as scary as the other chart now, is it? And then more charts. The AAI bullish sentiment percent, 2013 to 2023. Then we have some nice statements like highest since June 2021. And by this chart, you're like, wow, there's really no upside left. But what about the charts that I've shown you in recent time, just in the past few slides, that show that there actually could be a lot of upside left? Then, if you look at this chart, AAII bullish sentiment 2019 to present, you'll see that in the red, that's the S&P 500, and then in the blue is the bullish sentiment. And what does this tell you? Remember, that's what you're doing when you look at a chart. You're saying, what is this telling me? What statistics and charts are like bikinis. What they reveal is suggestive, but what they hide, what they conceal is crucial. So you need to ask yourself anytime you look at a chart, hear a fact, hear a statistic, you have to say what's not being said that's also true. For instance, let's not forget that in 2021, the market took 6 months to peak after the AAII peaked. If you look at this, the AAII peaked. Boom, it peaked. And say you were psychic and you knew the AAII has peaked. And you knew it was only going to go down. So what would you do? Would you sell your stocks? Would you buy puts? Then the market goes against you by 12% for the next 6 months. 12.39%. It went up from June 4th, 2021 to December 31st, 2021. So even though the sentiment indicator peaked, the market continued to go up over 12% for 6 months. So I hope those were some long-dated puts you bought. And this is the whole Newton concept. You know, he made money in the South Sea bubble, but then he bought back in and then he lost his money. If you sold out in June and the market kept going up, at what point would you have bought back in? Because you're like, oh no, I got the trade wrong. There must not have been something I discovered, blah, blah, blah. Whatever story you want to tell yourself and spin. And then you get back in and all you did was miss that move. and then you bought higher, and then in 2022, you would have had a hell of a time. Now, this is a chart that I don't know what to make of. I'm not familiar with. I don't know. I haven't read into it. This is the University of Michigan Consumer Sentiment Index, and it's at, yet again, highest since September 2021. Like, I'm not sure why that's the base effect we're using. Remember, when you need to question the concept in a statement as much as the statement itself. And in this case, the concept we're questioning is, why are we referencing it to 2021? Well, because that's the last time it was this high. It was like, okay, what's the particular relevance of that juxtaposition? Like, why does that matter? It just sounds dramatic. Wow, the market hasn't been, because it's something along the lines of, you're going to infer the market hasn't been this frothy or heavily bought for almost 2 years. Is that what you're supposed to infer? I'm not quite sure. And it's kind of interesting too. I don't know what to make of this chart, because you saw it really dipped hard and there was no recession. But most of the time when they dipped really hard, there's recessions. So did we have a recession in 2022? Well, that begs the question, what do you mean by recession? I don't know. So I don't know what they mean by recession. I know what I mean by recession, but I don't know what they mean. I suspect it's, I can't think of the agency, the acronym, that in something, 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 that tells you when there's a recession. So, interesting chart. Now, to finish up this segment of sentiment, here's a quote that I found in one of the comments in regards to, I believe, one of the AAII charts. Incredible how sentiment lags price action and then drives it at precisely the wrong moments, again and again. Well, first of all, someone saying incredible is sort of a statement of surprise, which is a statement of ignorance, because you don't get surprised by things that you're ignorant of. Because if you knew of the thing, you wouldn't be surprised. If someone tries to scare you hiding around a corner, you wouldn't be scared if you knew they were around the corner. So to say incredible is like, humans do incredible things, but I don't think this is incredible. It seems more of a, I can't believe that sentiment lags price action and then drives it at precisely the wrong moments. It's like, well, what do you mean by wrong moments? And is this statement even true? Like, okay, so sentiment lags price action. Well, that's because price action confirms narrative. Most people feel more confident about a narrative if the stock goes up in price, and then they feel less confident about that narrative if the stock goes down in price, because to most people a stock price is merely a floating abstract representation that isn't grounded in anything real like value, and they have no courage of conviction around value of a company, which is why sentiment lags price action, or that's why sentiment would lag price action. And then I'm not so sure if it even lags per se. I mean, that's why it would lag, what I just explained, but they kind of seem to move in tandem well enough. I mean, it depends on how detailed and microed and how high resolution you want to get on a chart, on a daily, weekly, monthly, but they seem to move pretty well in tandem. And then they go to say, then drives it precisely the wrong moments. I'm not sure if there's a correlation being conflated with causation, because so sentiment drives price action at the wrong moments is what they're saying. So the more bullish you get sentiment, the higher the stock goes, and the more negative sentiment you have, the lower the stock goes. And it's kind of a stair-step function, especially on the way down. because people slowly gain confidence, but then can easily lose confidence. And that's just how the human existence goes. So it just seems like a stupid statement, using stupid in the most loosest terms. It's a statement of ignorance, whether that's self-imposed or not, I'm not sure. So to sum this sentiment section of this up, what can we say? What can I say? I can't speak for any of y'all, and I don't know what you all are saying. So this kind of, interestingly enough, confirms how I've been feeling this entire year, which is, well, I'll just put it in layman's terms. I can't believe the market keeps going up. So that's a personal belief that's probably grounded in delusion and my inadequacy and so on and so forth. Like, I can't believe the market keeps going up, but I actually believe that the market will keep going up. And so far I've been right. I've been anticipating a pullback. Yet again, this is all just me, my psychic crystal balls and stuff. I believe that a pullback will happen in September. And the problem with that is I don't think the pullback will sufficiently be the kind of gut-wrenching pullback that I want in order to deploy capital, which means that I'm not, how do I say this? I think the market, let's just, simple terms, I think the market is going to fall in September. And I don't think it's going to fall as much as I want it to fall in order to provide me with the good buying opportunities, because I'm currently in 28% cash and accumulating a larger and larger cash basis. And that means I'm going to, weirdly, I'm going to have to chase, so to speak, because it's not going to fall as much as I want it to, which means I'm not going to get quite the buying opportunity I want, which means I'm going to hold out too long to deploy the capital, and then the market's going to start tracing back up, in which I'm then going to have to deploy the capital knowing that that was the pullback, which is what I mean by chase. And I don't know why I believe any of this, but that's what I believe. And it's interesting to see this, because I was unaware. I kind of thought that once the market hit the greed territory on the CNN Greed and Fear Index, that there was normally a reversion in the market of some sustainable degree, but that doesn't actually seem to be the case. And then if you looked at that chart after I showed you the long time frame one and go back to look at that 2-year time one, it actually does confirm that belief, but on a much more micro resolution than I thought, which means it's just a small pullback. It's nothing significant. And actually, now seeing this, it makes perfect sense to me. Like I said, sentiment maintains sentiment. You know, people are optimistic, so they use recent experience to perpetually extrapolate into the future in a linear modeling way. And they do that both with positive feelings and with negative feelings. So it kind of makes sense that when people get negative, the market stays negative, and when people feel positive, the market goes positive. It actually makes sense to me. I mean, that might just be me post hoc rationalizing, and that's not the reason at all, but now looking at it and thinking about it, it actually makes a lot of sense. So my base case still, the charts have looked so constructive. I kind of saw the inverse head and shoulders on a weekly time scale, and I was like, is this thing really going to break out? And it has, and it's, say, 6% above that neckline breakout on the inverse head and shoulders. And in some sense, I'm in disbelief, but at the same time, I kind of saw it coming. So the economy is looking more constructive and promising than people initially thought. And I mean, that's what happens when people think in nominal terms instead of real terms, and the government's running at an 8% deficit and so on and so forth. It really combats all this interest rate drama that you hear about. And we're going into an election year, and I mean, they're going to pull all stops out to try to make things look good for the current incumbent to be reseated, so to speak. That's the political affiliation. It doesn't matter, Democrat, Republican. The they're going to try to do all they can to make things good. So it's either get the recession out the way now and have 2024 be a stellar year, or postpone it. So we'll see what happens. And Erdogan in Turkey did that. They just destroyed the economy for the long term to make it look better in the short term by handing out all kinds of free stuff that they couldn't afford so he could get reelected. And then the liras dropped. That's the currency of Turkey. The liras dropped, I don't know, 25% since he got elected a couple months ago. So that's all to say, I don't think the pullback will be as much as I want or as much as people fear. And I mean, we're like 5% off of all-time highs. But if you actually look at a long-term trend line of the S&P, we kind of actually did revert back to the mean with the 2022 dip. And we've rocketed off of it, the October lows in a lot of sense. Well, the tech companies did. And earnings are looking better, or I should say less worse than what people anticipated, and so on and so forth. So I'm building a cash position to deploy the capital. So just watch a person's behavior and not what they say. There's a reason why I've been either fully invested or 75% invested all year, because the 25% of cash was a consequence of my bearishness, and the 75 deployment of cash in stocks, so the 75% of stocks, was a consequence of just because my belief systems are miscalibrated to reality doesn't mean I should go off of that. So the charts are looking constructive, things are looking constructive, I better be invested. And that's what you've seen me do, is be invested. So cautious optimism, to sum it up. No, the greed index being at 82, well, no longer really concerns me on a longer time scale, a multi-month time scale than it used to. And in the short term, I kind of think we are overextended. Maybe we retest the breakout. Yeah, that's a 6% drawdown, like whoop-de-doo. But as we've seen, momentum and emotions can carry markets a lot higher. And there's a lot of systemic reasons why that is, and I've gone on long enough. So I'll leave it at that and move on to the second section of this, which is going to be a shorter section. I kind of thought this chart was interesting of sector fund flows, and I don't care about the hyperbolic technology yellow bar on this. It is interesting. But then look at energy. So as tech's gone up, energy's gone down. So this is what people don't, back to the sentiment, I guess I couldn't leave it alone. In 2022, when people were bearish, the market, you then have to ask yourself, what's the market? And it's constituted of numerous sectors, subsectors, sub-industries, and sub-participants. And what could happen, and what kind of did happen, is that maybe tech, I don't know the numbers, so I'm going to make them up. Tech might be 10% of the S&P. And then energy could be 2% of the S&P. So the S&P could actually trade sideways, say for a year. But everybody's like, tech's overvalued, it's a big component of the S&P, therefore it's going to go down because it's so overvalued, and therefore the S&P is going to go down. And that's the wrong way of looking at it, because what could happen is, say, every percentage move that technology goes down, energy could go up 1. So tech could go from 10 to 9, and energy can go from 2 to 3. And it compensates it, which is why the market would trade sideways, because you wouldn't be getting full participation from all the market constituents and the subgroups and industries. But it could allow it to trade sideways, which is another reason why I haven't been as bearish as a lot of people. Now, I should also note on the bearishness thing, some smart people that I respect are bearish to the markets. They're announcing it for the first time. They haven't been one of these perma bears for the last, calling for a recession for the last 18 months. This is the first time that they're really pounding the table, if you will, about them becoming bearish. Okay, that's worth paying attention to. But what could happen here is tech could fall and energy can rebound. That's a possibility, and you need to consider that. You need to consider the spectrum of potential and probable as well as possible outcomes. Now, I wasn't planning that little tangent for making on this chart. So what I wanted to talk about on this chart was energy. Well, that's an interesting word. So yeah, it begs the question, what's energy? And materials, because we conflate the two. Like, are my uranium mining stocks energy or are they materials? Most mining stocks are, I believe, to be materials. So, but it's interesting because oil producers are considered energy, but uranium producers are considered materials. So I'm not quite sure how they define these things. But I do know that oil and gas, oil companies, which is a third of my portfolio, is something I should pay attention to. And oil and gas is part of energy. So it's cumulative global sector fund flows, which means people have been selling like mad since the beginning of the year in the energy sector. And people have been buying like mad the technology sector since April. So let's look at energy. Well, when you say energy, most people think XLE. It's a good placeholder for it. The Exxons, the Chevrons, the BPs, the big oil and gas producers of the world, as that's what's held in XLE. And I find this funny because in the last couple of years, I've heard from time to time people saying that the energy sector is selling off hard. But you know what wasn't selling off hard each and every time people said that? Was the offshore oil sector. So here the XLE is down pretty much flat for the year. But you know what's not flat? Valaris. Now, Valaris has been negative pretty much a good portion of the year. And it's one of the underperformers, if you will, of the offshore sector. But it's currently up 15%. PBR, which is a big one that people are talking about, it's up 46%. Ecopetrol is EC. It's up almost 12%. YPF is up 77%. Vista Energy is up 82%. Oh, so what do these all have in common? They're Latin America, South America, oil and gas producers. YPF, Vista, PBR, EC. So when people say that the energy sector isn't doing well, you then might hear, not knowing any better, I shouldn't buy energy, or this is the time to buy energy, depending upon how you function as a human being. But please keep in mind that if you own, for the most part, offshore oil and or Latin America oil and gas producers, you are actually doing pretty well this year. Matter of fact, I would say just these names I've listed, if you had a basket just of these names, you would be outperforming the S&P and perhaps the NASDAQ. I don't know. It's NASDAQ's what, 40% this year, so maybe not on that one. But you would actually be doing quite well and collecting some amazing dividends along the way. PBR was offering at one point a 25% dividend. I think EC is offering a 15% dividend. So yeah, when someone says energy, I guess always be cognizant of people's placeholder terms and how they like to conflate categories and make hasty generalizations that lead to jumping to conclusions, such as energy's not doing well, recession is coming, sentiment is at greed levels, therefore shouldn't buy energy stocks. Like, well, you really screwed that one up if you thought in such simple, overly reductionistic terms. And I would encourage you to not do that. This really isn't going along with the theme. I'll wedge it in there, but I thought this chart or this statement was interesting and it's worth noting, and I didn't know where to put it, so I'd put it at the end. And let me read it to you because it's worth considering. And the way I can make it relevant is sentiment's doing well because inflation's coming down. And one of the reasons around the fear around oil and gas is that inflation's coming down and recession and OPEC cuts and things of that nature. But oil actually generally does well in an inflationary environment. Hard assets do well in an inflationary environment. Commodities can do well in an inflationary environment. And inflationary recessions are not like normal recessions. And just like there's a difference between demand shocks versus supply shocks and commodity induced recessions, and all these variables need to be taken into consideration when making your forecast, instead of saying blanket statements like recession, commodities go down. It's too simple of a modeling of the world. So it says, eco-inflation waves are a product of maths and the economic cycle. First, base effects work both ways. Base effects were disinflationary in the past 12 months, but they will turn inflationary next year as prices will be measured against a lower base. Second, the disinflation of 2023 contains the seeds of the reflation of 2024. Personal income grew by 7.4% last month, far outpacing inflation of 3.1%. With income growing by 4.3% in real terms, strong demand could force prices to rise in an economy that is already running above potential. Now that's an interesting narrative that you really should think about, and the implications, and position yourself accordingly to the probability of that occurring. With that said, here we are at the end. Weekly update. Most of my names are pretty much around the same that they were last week, but banks are coming out and people seem to be quite optimistic about them. So as you see, KRE is up 25% and IAT is up 22%. And who knows the upcoming quarters, how this all plays out. I could see it playing out both ways, in which I round trip this or in which it keeps going up. Not quite sure. People talk about interest rates. If they keep raising interest rates, that's not good for the banks. But it's not just about raising interest. What people got wrong in 2022 about interest rates rising is good for banks is the rate in which interest rates go up. Because roughly 20% of a loan book comes off in any given year. Okay, so all that mark-to-market losses of held-to-maturity loans that were then being mark-to-market, or I'm sorry, yeah. So what happened is the reason that happened is rates went up really quick, and I mean, just imagine if that rate raising cycle in 2022 happened over a 5-year time period. That means the banks could adjust accordingly to it, with 20% of their loan book coming off every year, and then new loans replacing that at a higher interest rate. And worse yet is that most of the loans were at historical low levels, And now we're just getting back to more normal levels. So they weren't able to adjust quick enough. It was the rate of change of interest rates that mattered more so than the absolute interest rate. And what normally would be bullish for banks, i.e., incrementally progressive and higher interest rates, became bearish because they couldn't position and adjust their loan book at the same rate. And so they got penalized, and we saw that happen in March. With that said, that's really the only update that I have. LPX, Louisiana Pacific, seemingly, you get cult followings for certain sectors like offshore oil and uranium because those always do the best on my videos. But then when I talk about home builders, no one really cares. And when I talk about banks, no one really cares. And I really don't care about banks either. But home builders is quite interesting, but seemingly home builders do not have a cult following because videos I've made on them have gone absolutely nowhere. And I'm a small channel, so I'm keeping that in mind, but relatively speaking, those videos don't go anywhere. But Louisiana Pacific and Blue Links, which was a company I was also going to buy the same time I bought Louisiana Pacific, but I didn't have enough money in my account, so I didn't and couldn't, which is part and parcel of this channel, which is, how to grow a portfolio and deal with the difficulties of starting off with a small portfolio. That's one of them. Not having capital on hand to deploy when you want to and need to, and when the buying opportunities present themselves. So right now, Louisiana Pacific is right around that all-time high, around this trading range that it's been in for the last 18 to 24 months. And it's at the very top of that. And the past couple of times it's been at the very top of that. It then falls to the bottom of the range. Does that happen? I don't know. Blue Links is in the same thing. Interestingly enough, Boise Cascade broke out. And months ago, Builders First Source, which is a company I really want to own, but that pullback I was talking about that I anticipate coming up isn't going to be as much as a pullback as I want. And Builders First Source was one of those companies, BLDR is the ticker symbol, was one of the companies that I actually would like to buy. And I don't think I'm going to be able to do that because I just don't think I'm going to be able to pull the trigger on something that's ran so hard. I don't know, anchoring bias or something else. And that's unfortunate. So, but it's interesting. Boise Cascade broke out not that long ago. Builders First Source broke out a few months ago. And then Blue Links and Louisiana Pacific are at the top of their ranges, appearing to potentially be breaking out if they follow the rest of the sector. I don't know. See what happens. Kinross Gold's bounced pretty well in the last couple of weeks. I'd like to deploy some more capital in a particular royalty company. See if this future pullback that I anticipate might be able to deploy some capital. I don't know. I don't really have the gold bug fever in me, so if I don't, I don't really mind. Uranium is disappointing. The Sprout Physical Uranium Trust, the SPUT, is trading or was trading at like a 15% discount, and that's unfortunate. And then the peak we had with spot price going up to 59, it's pulled back to around 54, 55 last time I looked. And I mean, onwards and upwards with long consolidation periods, with occasional breakouts is how the uranium sector works, and that's how the offshore sector works. I was red and negative for most of this year so far in the offshore sector, and then it's finally broken out, and that's just how that game goes. So if recognizing that helps you hold through distressing periods. With that said, I believe that's all. That's all I have this week. So with that said, thank you for watching, and until next week.